Hello and welcome to our monthly market update video for April 2021. Today we're going to dive into some of the primary differences between the real estate boom that we are in right now and the real estate boom that we experienced back in 2005 through 2007.
Hi everyone. Most of you have probably either had the conversation or definitely overheard someone having the conversation that we're in another mini bubble. It's going to burst soon. The world is ending. All of the doom and gloom that comes with real estate. So Steve and I thought we'd really break down the differences between what we saw pre-recession and what we're seeing in today's market. Again, all of our data comes from the Cromford report. We can't thank them enough for providing us with such great detail.
So one difference between the 2005-2007 market and now, 100% financing was rampant back then. So people had no equity to start right after they purchased the home. Now people are putting down payments down 10, 20% or more. So they have built-in equity to start.
Lending practices used to be a lot looser. People could do interest-only loans. They weren't building any equity. Nowadays, people are doing principal and interest payments, building the equity along the way.
A third difference, back then people were getting adjustable rate mortgages, so their payments would adjust with the interest rates. Now people are getting fixed rate mortgages, so their payments don't adjust.
We're also, back then we didn't see as many cash transactions. We're always amazed about how many actual cash transactions are happening right now, even at the top end in the $2 million market.
Back then, appraisers were pressured by commission parties to bring in values. Now appraisers answer to underwriters on valuations, so they're separated from those commission parties.
Buyers then were pretty unstable. They just had to have a pulse to get a loan. Everyone's heard that phrase before. So now buyers are much more stable with solid credit, down payment, etc.
Back then, there was no intent to occupy by the homeowner, so there was a false demand being created. Now there's an intent to occupy with either a renter or the actual homeowner.
We were seeing a lot of double escrows, which means that a house would sell and would be bought and sold in the same day, moments apart. Nowadays, that just doesn't exist, and in some times it takes full disclosure even to happen, if at all.
The job growth that we were seeing back then in 2005 through 2007 was in the real estate, construction, and tourism industries, which are all very cyclical industries. Now we're seeing job growth in the health, financial, and tech industries, which are very diversified and less cyclical.
And that diversification has really led to more migration into Arizona. Back then, we just saw normal standard levels of migration, high levels of investor influx that came in to buy those homes. And now we're seeing high levels of migration to Arizona, people who are actually living in these homes.
Back then, there was no equity. People had no equity, so it was leaving homeowners with very few options following a market correction or if they fell behind on their payments. Now people have significant equity, leaving them with multiple options if the market happens to correct or if they fall behind on their payments. So, while we are certainly not in the business of predicting the future, and we obviously don't have a crystal ball, we do pay close attention to things that we are experiencing on the ground on a daily basis, and we pay close attention to market statistics, primarily those provided by Michael Orr and Tina Tambor at the Cromford report. When we consider all of our on-the-ground experiences, the market statistics, and the differences between the last boom and this boom, we just simply do not believe that we're in the middle of any sort of a bubble.
And this huge population growth that we touched on earlier, we haven't been building for that. So post-recession, building really slowed down. Building permits are slowly ramping up, but now they're faced with lumber shortages, labor shortages, so the cost of both of those have risen. So the cost of those new homes is also going up. So once everything stabilizes, we believe we're going to see a leveling off, not an actual crash in the market. The bottom line is that it's going to take a while for this boom to stabilize.
Thank you very much for listening to this month's market update video. And as always, we would love to hear your thoughts and information on the information that we just provided. Whether or not you found the information useful, helpful, whether or not you agree with our assessments, or if you just want to chat about the market in general.
Next month, we're going to take even a deeper dive into some of the additional factors that are having an impact on our market. as well as some of the things that the government is doing to help create a softer landing for those homeowners who have fallen behind on their payments during the pandemic. But don't worry, we aren't anticipating a wave of foreclosures. Thanks again, everyone. Have a good month.
See you next month. Thank you so much.